It was a sell-off that really felt like it came out of nowhere. One minute things are fine, the next stocks, crypto, pretty much all risk assets. Everything is flashing red. But underneath those headlines, a series of hidden pressures have been building up for months. And today, we're going to uncover the mechanics behind what's really going on, the market's perfect storm. So this is the big question on everyone's mind, right? Why is everything selling off all at once? One day the market is humming along, and the next it feels like the floor just completely dropped out. Was there one single trigger for this, or is there something, much deeper happening? Now, the mainstream news will give you a couple of obvious reasons, and yeah, we'll touch on those, but the real story, the one that explains the sheer violence of this move, is hidden away in the complex plumbing of the market itself. So that's exactly where we're going. Let's dive in. Okay, so the pain was absolutely widespread. It really started with the tech-heavy Nasdaq. It dropped 1.2% in just one session as the first cracks started to appear in that big AI rally. All those worries about valuations being way too stretched, well, they were finally starting to bite. And it wasn't just tech. The selling spread to the broader market, which we track with the S&P 500. It fell sharply too, closing down 0.8%. And that marked its fourth straight day of losses, which really signals a much wider problem. And it didn't even stop with stocks. Bitcoin, which is often talked about as this alternative asset, got hit even harder. It plunged nearly 9%, wiping out all of its gains for the entire year. This was a true risk-off event across the board. So let's start with the story you've probably already heard, right? There are a couple of big, pretty obvious reasons for this sudden change in mood that everyone's talking about. For most of the year, the market was running on two really powerful ideas. You can see them on the left here. The Fed was definitely going to deliver steady rate cuts, and that the AI boom was just unstoppable. But now, well, the script has completely flipped. Both of those hopes have soured into major fears. And the trigger point came straight from the Fed. When they start using language like uncertainty remains elevated, the markets listen, and they repriced everything, like immediately. That hope of guaranteed rate cuts that had fueled so much of the rally, it just collapsed. But honestly, that's only the surface story. Now we're going to get to the first hidden layer of pressure, and it's coming from a corner of the crypto world that very few people were actually watching. All right, so you need to know about this new breed of company called DATCOs. These are publicly traded firms, and their whole pitch was basically acting as a way for regular stock market investors to get a piece of the crypto action. They raised billions and billions of dollars just to buy and hold digital assets on their balance sheets. And the amount of money they raised is just staggering. In 2025 alone, these companies funneled over $42 billion into crypto. Now, when crypto prices were going up, this was like a massive one-way fire hose of cash pushing things higher. But how they raised that money, well, that created a hidden and very dangerous risk. This illustrates a really dangerous feedback loop. Some people are even calling it a death spiral. See, a lot of these DATCOs use debt to buy their crypto. So when crypto prices fall, that's step one, they suddenly violate the terms of their loans. This triggers step three. They are literally forced, to sell their crypto to get cash, which, you guessed it, pushes prices down even further, starting the whole cycle over again. They become forced sellers at the absolute worst possible time. So that forced selling from the crypto world is one huge problem, but it's running straight into an even bigger, more systemic issue, a historic, record-breaking level of debt in the traditional stock market. Yeah, you're seeing that right. According to the latest data from FINRA, investors are borrowing a record $1.18 trillion. This is what we call margin debt. It's basically money you borrow against the value of your stocks. And this is the highest level ever recorded in U.S. history. Ever. But here's what's really, really alarming. It's not just the total amount, it's the speed of the growth. This chart shows margin debt has exploded by over 45% in the last year. Meanwhile, the market itself is up just 19%. That means borrowed money is flooding in more than twice as fast as the market's actual value is increasing. That is a classic, textbook sign of speculative excess. And if you look back at history, this is a huge, flashing red light. I mean, look at this. Every single previous spike of this magnitude in 2000, 2007, and again in 2021 was followed by a major market crash or a very significant sell-off. It is a warning signal that has flashed right before every major downturn. Okay, so let's connect the dots here. We've got forced selling coming from the crypto world. We've got potential forced selling from stock investors facing margin calls. That's when your broker demands more cash to cover your losses. But what turns all this pressure into an actual crash? Well, it's a simple lack of buyers. So you have this building wave of investors who don't want to sell, but they have to sell. They have no choice. They've got to cover their debts. And they are trying to sell into a market where the professional buyers, the people we call market makers, have just vanished. They see the forced selling coming and they just step away. They pull their bids and all of a sudden liquidity completely dries up. And the impact is just dramatic. In the crypto market, Bitcoin's order book depth, which is basically the wall of buy orders waiting to absorb any selling, it collapsed by 33%. That safety cushion just evaporated. And what that means is that now, even a pretty small sale can cause a massive sudden drop in price. So, with all this turmoil, we have to ask the big questions. How bad is this really? Is it a bubble bursting, a correction, or is it something more? Let's try to put all of this into context. The short answer, at least based on the current data, is no. Look, the 2008 crisis was a systemic failure of the entire banking system. Right now, credit and funding markets are still working normally. This seems to be more of a sharp repricing of risk and valuation, not a full-blown banking shock. So what about a repeat of the dot-com bubble? This table highlights some really critical differences. Yeah, valuations today are high, no question, but look at that profitability row. Unlike the cash-burning startups of the year 2000, today's AI leaders are immensely profitable companies. They're funding all this expansion with their own revenues, not just speculative cash. The fundamentals are stronger, but as we've just seen, the leverage risks are very real and they are growing. And this really brings us to the core of the issue, and it's captured perfectly on this slide. Leverage works both ways. The same borrowed money that juiced all those games on the way up is now creating a brutal downward spiral. This sell-off isn't just about AI hype or what the Fed is doing, it's a structural test of the market. It is a very painful reminder that when the market is sitting on a mountain of debt, the real question isn't just about fundamentals, it's about how much pressure the system can actually handle before something finally breaks.